Hi, y'all. Welcome or welcome back. I want to ask you a question today. If you could go into a time machine and get somebody else's 2 to 3% mortgage rate, would you do it? I think most of you would say yes. Today, it's not a fantasy. It's called assumable loans, and that's what we're going to talk about today. So here's what it means in plain English. Starting a brand new mortgage at today's rate, you can step into the seller's existing loan and you inherit the rate. So let me share my screen and we're going to go into that right now. Today we're going to talk about unlocking hidden value in the Houston's market. Let me get into this. All right, there we go. So today we're going to talk about unlocking hidden value in Houston's market. It's a strategic look at assumable mortgages, and then we're going to talk about an inner loop development. So let's get into it right now. All right, so here we go. As at the beginning, I asked you, would you want to get a 2 or 3% mortgage if you could pull back time? And I'm sure the answer is yes. So in some cases you can. It's called an assumable loan. Here's what it means in plain English. Instead of starting a brand new loan at today's interest rate, you step into the seller's existing loan. You inherit the interest rate that's the remaining balance and the remaining years on the loan too. If the seller's locked in at a 3% rate a few years ago, that rate belongs to you because you're assuming it, not just the original buyer. So if you qualify, you can potentially take over a 3% rate and plug it into your own budget. So let's get into the strategies behind that. Now, assumable loan is, as I said, a fixed rate time capsule. You will inherit three components here. Their interest rate, which is locked in. So let's say they got a 2020 interest rate or 2021, which are unheard of right now. You also inherit the remaining balance. You take that over and the remaining terms of the existing loan. So let's keep that in mind. I also wanted to talk about, and it's not showing up here, so let me see if I can find it. Yeah, let's just talk about it anyways. There's such thing that most of the TikTokers and so forth don't talk about, and it's called the equity gap. So within this process, there's also an equity gap. Let me explain to you what that means. So let's say that the home at today's price is 400, but the remaining balance of the assumable loan is 280,000. That means that there's a $120,000 gap between what the seller wants and what's left on the mortgage. You have to cover the gap either in cash or in a second loan. So you need to understand that. Most people talk about the amazing part of it, which assumables are amazing that you could get that rate. But also there is a gap that you have to consider. It's called equity gap. So keep that in mind when we're talking about assumables. Now let's get into the VA loan assumptions too. I want you to understand this too. There's a common myth that you must be a veteran to assume a VA loan, and that is incorrect. A non-qualified veteran can apply for the loan with the current loan servicer to assume the loan. The approval process is similar to a standard loan. The servicer in the VA underwrites the buyer's credit, income, and debt. So just understand that. That is a myth. You don't have to be a veteran to assume a VA loan. With many VA loans, like I said, you qualify through the servicer. And on the seller side, if you're a seller and you're a veteran, their entitlement is usually tied to that loan. And that's another detail in itself to get into. Now, you can also assume an FHA loan. And FHA assumptions are for everyday borrower opportunity. Many FHA insured loans, they're assumable, and there's a specific pathway to secure the low interest loans. The low interest loan belongs to the loan, not the original borrower. The qualified borrower applies to assume the seller's exact loan, same rate, and same remaining terms. That's important to know too. And I did just talk about the equity gap earlier, so this is a slide on that. So you need to understand that. When does an assumable loan make strategic sense? So let's talk about that. That's an important question to ask. It makes sense, and it's a powerful advantage when three conditions are met. A truly low rate. In other words, the seller is significantly lower than the current market, creating a substantial long-term savings. Remember that. Number two, a manageable equity gap. The gap between the sales price and the loan balance is something you can realistically cover with cash or a well-structured second loan. So think about that. And number three, the blended payment works. After all the math is done, including the second mortgage, the monthly payment fits your budget and your financial goals. So remember those three, or reference this video. From a financial strategy to the on-ground opportunity, let's shift right now. And I want you to understand assumable loans. Well, hopefully you got some knowledge of that. But let's shift into what's happening in the market here in the inner loop of Houston in the Heights. So it's a new retail space is coming. And here's some specs on it. It is a 24,000 square foot building, 2-story retail space project. The design includes a second-story parking area or space for around 150 cars, which is a big deal for that area. This is in the Heights. So let's move on. You can see the spot here on the map, 2401 North Shepherd Drive. So it's involved in a demolition of an existing commercial structure, including Miller's Auto Body Repair Experts. The demolition started in late 2018 for delivery in 2019. So it should be up. The developer is targeting national level players to create high traffic destinations. So here's some of the target tenant mix, like a ramen restaurant, Mexican restaurant, pizzeria, nail salon, high-end fitness studio. This is in the Heights again. So let's talk about the two things I covered today, which is your financial tools, assumable VA, FHA loans, and that's an underutilized method to bypass high interest loans and improve affordability, which we love. Number two is the market focus, which is a hyper local development that we talked about today. And it's important to know what's going on in these areas as you move into them, so you can see how feasible it is, or what's happening in the area in particular. So here's the big picture today. On one side, you've got assumable loan, FHA, VA, and you could potentially get a 2 or 3% interest rate. Again, like turn back time, because that's not happening again, most people say. On the other side, you've got real projects like the one at 2401 North Shepherd Development that's reshaping actually what the place looks like, and it's enhancing the Heights, more restaurants, more amenities, more reasons for people to want to live nearby. So if you're thinking about moving, building, or purchasing, my name is Lisa with Real Haven Realty, and I am here for you. I am your internet agent and the hardest working realtor in the area. I'll see you in the next one. Bye. See you later.